All right, everybody, welcome back. You know what time it is, right? What time is it? It's LIFO time. Let's go. All righty, LIFO. You ready? LIFO, we sell the new one. Last one's in or the first one's out. We sell the new, the unsold, or the old. Don't say you're selling the expensive, because I don't know if we're in a rising price environment, inflationary or deflationary. So with LIFO, you're selling the new, which could be expensive or cheap, depending upon what's happening to prices per unit. So, same facts as before. Before we go through the example again, LIFO conformity rule. All right, so my friends outside the U.S., in the United States, if you want to use LIFO for tax purposes, which a lot of companies want to do for tax purposes, because in a rising price environment, if you use LIFO for tax purposes, you'll show the government a higher cost of goods sold, which will reduce your profit, your taxable income, which will reduce the taxes you pay to the government, which will actually increase the company's real after-tax cash flow. So in the U.S., if a company is profitable and they're looking for avoid taxes legally to reduce their tax obligation, in a rising price environment, they want to use LIFO. Now, there's a catch. If you want to show the government a higher cost of goods sold or lower profit, then you got to use that same method on your income statement. You can't mix and match. So if you use it for tax purposes, LIFO, you got to use it financial reporting when you do your income statement and balance sheet. You got to use both. You can't mix and match. It's not like depreciation, where in the U.S. you can use straight line on your books for financial reporting to show a lower expense, a higher profit, but then on the tax return, accelerate your depreciation to show a bigger expense, lower taxable income. That is allowed. You can mix and match depreciation, but you can't mix and match LIFO and FIFO. Okay, if you use LIFO for tax, you got to use it for financial reporting. Okay, the thing we like about LIFO as a general rule of thumb, you've got a better matching of revenues and expenses, because think about it. Selling price is today's cost, right? And what are you expensing? Not the old stuff, the new stuff. So it's current selling price matched against the current cost, which is a better matching. Unless, of course, you haven't bought inventory in a while. See, companies are not stupid. Whoever's managing the business realize if prices are rising, then what do you probably want to do? Well, I'm not going to wait. If I know for the year, let's say, that I need 100,000 units, I'm not going to buy them little by little throughout the year. If you have the space to store it and you don't think it's going to go obsolete and you're confident prices are going to be rising, well, you want to lock in today's lower price. So sometimes management is smart and they're using LIFO, okay, but what they're going to cost, what they're going to expense only represents today's cost if the unit was recently acquired. So if we're in November and you haven't bought inventory since January, even though you're using LIFO, what you're expensing in November actually represents January's cost. So in a rising price environment, LIFO sometimes, if an analyst doesn't know what they're doing, they might think, oh, the company's being conservative. That LIFO cost of goods sold must be higher cost of goods sold, lower profit. Not really. The only way LIFO is a current matching of the cost and the revenue is if they're buying inventory in the current period. If they stockpiled earlier in the year, then the LIFO cost of goods sold doesn't actually represent today's expense. And how do you know that, by the way? If you're a financial analyst, how do you know management's using LIFO? How do you know if the cost of goods sold represents today's cost? Look at the inventory balances. If the inventory balances are not being replenished, you have a high inventory balance in January, and then February, March, April, May, June, July, it's going down, 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 down. That tells you they haven't been buying it recently, okay? But nonetheless, in a rising price environment, folks, just like we did with FIFO before I go through the example, assets equal liabilities plus equity, right? Selling price minus cost, there's your profit. So in a rising price environment, where do we start? Our cost. If you're using LIFO and the price per unit is going up, then you're truly selling the new expensive. Higher cost, lower profit. Lower profit, lower retained earnings, lower equity. Now look, if you got a lower equity, you got to have a lower asset. And then you can directly figure that by saying, okay, if we're selling the new, which are the expensive, then the old unsold are the cheap ones. Oh yeah, that makes sense that the assets are lower. Okay. Now, another thing to note about LIFO, unlike FIFO, where you're going to have the same ending inventory and cost of goods sold, whether it's perpetual or periodic, that is not true with LIFO. With LIFO, your ending inventory and cost of goods sold, when you do it periodic, will be different from what it is perpetual. All right, so let's do periodic first. Look at how I have it set up. So in the left column, beginning inventory 0, plus your purchases 9,000, 4,000 at 4 1/4, 2,000 at 450, 3,000 at 475. Cost of goods available for sale again 40,250. They told me I sold 4,000 under LIFO. Which ones did I sell the newest? Bottom up. 3,000 at 475 and then another 1,000 at 450. So my cost of goods sold would be 18,750, meaning I can plug my ending inventory. That's 21,500. Okay, or you can find your ending inventory directly. Your ending inventory are which ones? The oldest ones. Under LIFO, you sell the new, the unsold, or the old. So top down, the 4,000 at 4 1/4 weren't sold, and then 1,000 at the 450 weren't sold. Same result, different format. Okay, and then looking at the solution here for the perpetual. All right, you start with where you are at the beginning of the year. We bought a batch at 4,000 units. We bought a batch at 4 1/4 for $17,000. That's what you have available for sale. Well, you then sell 3,000 units. Well, they have to come from that 4 1/4 batch. There's no other batch it can come from. So 3,000 at 4 1/4, you got cost of goods sold of 12,750. Okay, then we buy 2,000 units at 450. Okay, 2,000 at 450, that's another 9,000 of units available for sale, $9,000 worth. We then sell 1,000. Check this out now. Where's that 1,000 going to come from? The 4 1/4 batch or the 450 batch? Last one's in, first one's out. That 1,000 that was sold will come from the 450 batch, the most recently acquired. So that cost of goods sold is 4,500. And then we buy another 3,000 at 475. Those units are available for sale at 14,250. So look, cost of all goods available for sale, it's still 40,250. What's our cost of goods sold? Well, we sold 3,000 at 4 1/4, 1,000 at 450. So 12,750 plus the 4,500. Cost of goods sold 17,250. Your ending inventory then is a plug figure of 23,000. And notice how your ending inventory periodic, 21,500, does not equal your ending inventory perpetual, 23,000. And my cost of goods sold is going to be different as well, okay? Okay, dollar value LIFO. This is easy stuff. You ready? Pray for this on the exam. You're going to rock this. You need an estimate of changes in price levels. That's required. So to do dollar value LIFO, it's very simple. But what you need is an estimate of the changes in price levels. That's required. Now, sometimes it's given, sometimes it's not. All right. So the price index, if it's not given, how do you do it? Take your ending inventory at your current year cost, divide that by your ending inventory for that year at your base year cost, and that's the price index for that year. And if prices are rising, the numerator will be bigger than the denominator. Your price index will be greater than 1. Okay, so check this out. Look at this example. You ready? It looks overwhelming. What we're probably looking to do is the right-hand column, the dollar value LIFO. All right, so the step number 1 is, for the first year, I need my price index. So I look at my ending inventory at my current year cost, 54,000. I then take that same ending inventory, divide it by my base year cost. That would be 45,000 if prices hadn't changed. So that's a price index of 1.2. All right, so for the very first period, my beginning inventory, January 1, year 1 is 40,000. Now, we had acquisitions, year 1 layer. We had 5,000 of acquisitions. With dollar value LIFO, I got to revalue that inventory of $5,000 using the price index of 1.2. So rather than adding 5 to the 40, 5,000 times 1.2 is 6. I'll add 6,000 to the 40. Now I got $46,000. Okay, for period number 2. Step number 1, ending inventory at current year cost, 80, divided by ending inventory at base year cost for year 2, 60. 80 divided by 60, we got a price index of 1.33. So then I look at my acquisition, my year 2 layer, we added $15,000 worth of inventory. But that's at base year cost. Using our pricing index, I take the 15,000, I multiply it by 1.33, I'm going to add 20,000 in my right-hand column. So 40 plus 6 from year 1, 46. Now add the 20, you would now be at $66,000. Okay? Just be mindful. You'll see examples where they try to mess with you, like the base year. there might be some numbers missing there. So they might give you the 40 and let's say the 45,000. And then in year one, you got to figure out, well, what was acquired? Duh, $5,000. 40 plus the 5, that's where they got the 45. All righty. Or let's say in year two, current year costs, let's say year two, they give you the 54 and then they give you the 26, but they don't give you the ending inventory year two at current year cost. But if they give you the 54 and the 26, add that together, what do you get? 80. All right, so no big deal. You shouldn't have a big problem with that. All right. The last thing we want to cover is just, you don't have to memorize this, but remember, in our example, prices per unit were rising. Okay, so we're going to compare periodic and perpetual. And in our example, the prices per unit, I should say, were rising. All right, notice FIFO, whether you do periodic or perpetual, your dollar amounts are the same. Ending inventory and cost of goods sold was exactly the same, periodic or perpetual. All righty. Now, periodic, you can't use moving average. You're perpetually moving. So for periodic, what do we call it? Weighted average. For perpetual, what do we call it? Moving average. And then LIFO, your numbers are not the same. Your ending inventory and cost of goods sold periodic under LIFO is going to be different than your ending inventory, cost of goods sold, LIFO, and perpetual. But nonetheless, what holds true in a rising price environment, FIFO, you sell the old stuff. So you'll have the cheapest cost of goods sold, periodic or perpetual. FIFO is going to give you the lowest cost of goods sold because you're selling the old cheap stuff. What's unsold are the more expensive stuff. So you'll have your highest ending inventory under FIFO. The average is always in between, whether it's weighted average or moving average. And then LIFO, in a rising price environment, LIFO is going to give you what? Well, you sell the new ones. So LIFO will give you, relatively speaking, the higher cost of goods sold and then the lowest ending inventory value, okay, relative to the other methods. When is it advantageous to use LIFO? A profitable corporation that's looking to legally avoid taxes to reduce their tax liability, they want to use LIFO because that LIFO cost of goods sold will be the highest, okay, assuming they're buying inventory and at current costs, right, when prices are rising. All right, and they didn't stockpile it earlier in the year. So LIFO cost of goods sold being higher is advantageous on a tax return because you show the government a bigger expense or lower profit. That reduces your taxable income. That'll reduce your taxes due, which will increase the company's actual after-tax cash flow. Folks, it's too much information here to memorize, okay? You really got to understand this, please. You know, certain things, yeah, perpetually moving, stuff like that, you know, but I think for the most part, dollar value, LIFO, like how do you do the price index? But understanding the difference between LIFO and FIFO in a rising price environment versus declining, set it up just the way I showed you and you'll be in great shape. And you can reason your way through how those things affect ratios. Okay? All righty. Good luck studying. I'll see you guys in the next one.